Hello everyone. Wish you all a very happy Diwali. This is Prasenjit Gupta, the business head of Clover Capital. As we stand in front of 2022 and at the market level of 18,000, I thought of creating this small video which will answer many of your queries of how to build a portfolio in 2022, what to do with your existing portfolio, what are the sectors you should be bullish, and what to expect in general. So, I will briefly touch upon the asset classes, the view on sectors, the new asset class in crypto, and a bit of fixed income, and how to construct and go about building a portfolio in 2022. As we stand today, how has been the year? The year has been fantastic. From 2020 April onwards, the market has been up, up, and up. It's a parabolic return. It's an exponential return. It's a burst of return. So, as we stand today, you should be happy if you had invested and stayed invested amongst all the panic and amongst all the news. So, it has been tough year emotionally for all of us, but on the financial plan, most of us has created wealth if invested properly. But does this return came out of blue? Was that only Corona that caused this? So if we go back a little and look at the longish term return of the equity market, in that case, I'll take you to the graph of it. If we see that from February 2015 to February 2020, this 5 years, the market only gave 41% cumulative return in 5 years, which is less than 5.5% return CAGR. So, for 5 long years, the largest market cap index in our country, that is Nifty, gave only 5% return. So, we were already strolling. The market gave a very meager return for equity. We were even underperforming fixed income in this phase. So, we were coming out from a very low return regime, and then Corona happened. So from the low of Corona of 7,800, we are at 17,900 odd, which is 122% return in 1.5 years. But if we take the 6 years average, we have given 100% cumulative returns in 6 years, which tantamounts to the long-term average of Nifty of 11.2. So it's not only that this astronomical return came out of blue, so it has a precedence that it was coming out of a anyway a very lull period for equity. So this means that the earnings were also not that encouraging to support the equity market at this point of time. I will go back to my presentation. If you see, the major factor that contributed to this return is the concerted effort of the central bankers to keep the liquidity situation very fluid. What do I mean? The market interest rate were at record lows or still at a very low level compared to the historical levels. The central bank did everything so that people have money in their pockets. So US has their payroll program. We also had our own subsidies. so that people have money in their hand. So all this liquidity, chasing of equity as an asset class. Then we had the TINA factor. TINA factor in the sense there is no alternative. It's an acronym of there is no alternative. Now, what are the asset classes we have? As we go back in 2020, maybe April, May, June, around that period, we had fixed income, which was giving very low returns. It crashed worldwide. Gold already peaked by that time, post Corona, and it historically also in the preceding 20 years haven't been that encouraging. Real estate has been struggling still from the subprime crisis. So it's maybe from 2011 to 2021, this 10 years, it hasn't given return. So equity obviously gave the opportunity to people to invest their savings. Now, with the crash in the market also became quite attractive from the valuation perspective. So, liquidity, valuation, all this prompted people coming into equity market and investing in holds. Got so many demat accounts being opened, and so many new investors coming in, so many new folios created in mutual funds. So all this created this virtuous cycle of money chasing the assets, especially the equity asset. Then the PE expansion happens. Obviously, the earnings were subdued. Last year, we had lockdown push almost for 6 to 9 months in some parts of the country. So the earnings, obviously, they were not functioning. Most of the economy were not functioning properly, barring few sectors. So we had this PE expansion. Now, PE expansion also is a function of your interest rate in the economy. So if the interest rate goes down, anyways, your expectation from the equity or the riskier assets goes down, and that makes a PE rating. So we had a PE expansion. Now this year what we are thinking about is an earning expansion to catch up with the price. So we started discounting the earnings in 2020 of 2021-22, where we thought that normalization will come back to economy and all this liquidity and positive vibes will catch up the price and the PE will come to normal level. Now, going forward, what are the factors? As you see, last year we got record inflows of FIIs because it was chasing returns. In the mother market, in the markets they get their investors from, the returns were abysmal. So they chased returns across the world. US gave fantastic returns. Actually, the world, barring China in the later part of this year, gave a fantastic returns, and India is also a beneficiary of that. We got highest FII inflow in financial year 2020-2021. But not only FII, the encouraging fact is the DIIs, the domestic institutional investors, led by the mutual funds, insurance companies. They also got record inflows. We had on average 8 lakh to 10 lakh of new folios being created and 8,000 to 10,000 crores of SIPs coming in to equity schemes every month. This contributed the retail participation in the market. So DIIs are now a formidable force when FIIs turn cold feet. So it's not the past. So it's a different kind of India right now. It's not that FIIs are only calling the shots. It's DIIs are counterbalancing in a long way along with the retail investors. Now, we might not have taken cognizance of the fact in this last 1.5 year, 2 years, the government has done a lot on the policy part. And I dare to say India has done the most reforms in the financial system, in the monetary and the fiscal side in the last 1.5 and 2 years in the world amongst the big economies. Be it abolition of retrospective tax, the PLI scheme, the telecom relief, all these things attributed that government wants our economy to revive. And the seminal decision of reducing the corporate tax, it's an economic decision where they try to increase the profit in the hand of the companies and address the supply problem rather than infusing money through MNREGA and those welfare scheme to the demand side. Indian labor are in abundance, there's always in excess, so that's not the problem. So if you try to address the demand side without having adequate supply, we will stoke inflation. And that we have seen the aftermath when MN, MNREGA started in 2006-7, and then when the economy cooled off, the inflation stoked off. So what government did, they tried to create the supply side infrastructure by giving more money to the corporates so that they create more jobs, which will create more demand, and now virtuous cycle will start. And we should take note, a serious note of this. This policy played a big role, and the CGSTMA scheme for the MSME, the enhancement of the credit limit to ensure that they uh, keep in their business. So on working capital enhancement, all these things attributed that government was very active during this period. Now we are all worried about FMC decision of when the tapering will start, and then there will be a big shake off. I want to tell you one thing. Market never falls on known risk. It always falls on unknown risk. Corona was an unknown risk of shutdown, complete shutdown across the world. So the market failed and crashed. But FOMC decision, the tapering, all this thing is already factored in. And what is different from the past FOMC decision when the tapering talks started in 2013-14, we were not prepared. So even emerging market, there was a lot of flight of capital and we corrected a lot. So this time we are prepared of a tapering, which will happen gradually, and FOMC has been quite active in preparing the grounds of a gradual tapering of its financial liquidity program. Now coming back to the earnings. The earnings, the estimates that we are working on is 20 to 22% for the next 2 to 3 years. Because as I said, preceding 5 years has been very abysmal on the earnings front. And so coming out of a very low base effect and with inflation aiding, our earnings obviously should be around that much. And once the earnings comes in, the market already knows this. Market is very smart. Market is not like, it's very smart. It has all got a complete view of this, that earnings will support, earnings will come. So if earnings come, I think we are in a cyclical bull market. But if it doesn't come, then a correction should be there going in a few months down the line if the expectations are not met. But we should be prepared for a earning season which would be of positive surprises. Now, what are the sectors that we are positive about in the next 1 year, at least in the equity side? Data and IT. Now, data means the people who are handling data, or who are the custodians of big data like Zomato, India Marts of the world. So they have enormous data about India and the spending habits and all these things. They would benefit a lot because data mining, data analytics will create a lot of insights into how we spend. Reliance, all these people, they have a lot of data. So they will be an eventual thing. And IT has gone through a complete re-rating, as we all know, and it will at least go on for a few more years, especially the mid-cap ITs and the ITs which are very niche in the like Apple India and Mind Trees of the world. So they address a specific problem and they try to be the market leader in that segment. So search for those kind of companies. Discretionary spending. This is one thing which will come back. People have been quite conservative in their spending. But as we saw the recent retail spending data, that it has been broken all the records of maybe 1.3 lakh crores this Diwali or this festive season. So discretionary spending. And amongst that, the sin sector or the vice sector, whatever way you call it, the cigarettes, the liquor companies. So all these people look out for good there, good companies there, and you could make a good, nice return out of those companies. This is one sector after 11 years which is showing some positivity as Indians aspire, or across the world, people aspire to stay more at home. So, real estate is one sector which is showing signs of recovery, and it is also expected as the cycle goes of any asset class. And if you go back to history, mostly an equity market boom is followed by a real estate boom for a few more years. So, real estate, how do you play it? Whether you play it through the allied sectors like home furnishing, home supply material, cement, or maybe tiles, the wares, the electrical appliances, but all these things you can look to have in your portfolio the allied sectors. So you can play all this. And if real estate is coming up, the financials need to be there to supply the oxygen. The money should be fluid. At the home loan rate, sub 7, maybe 6.5 in some cases, customers are now getting lured, or I might say, is real estate is looking lucrative. And once the interest rate cycle bottoms out, the financials will have a lot of NIM being added to their margins. As the borrowing cost doesn't increase, it has certain stickiness, but the lending cost increases across. So there will be a positive spread effect on the financials. The NPA problems majorly is over, majorly is written off. So whatever comes back gets written directly to the company's reserves. So I am very bullish on the financial sector, maybe a bit overweight also. So look for good companies, good banks, good NBFCs, and there are a lot of gems there still. So look for those. Obviously, if everything is rosy, what could derail this equity run? Drastic change in stance by central banks. If the central banks across the world, or majorly the developed world like UK and Europe, starts increasing the rates at a very alarming rate, which is not in congruence with the, or maybe not expected by the market, there is a chance of a fall, especially in the emerging market. So drastic change will obviously affect our The China factor. Now, China has a zero corona policy. So now we are seeing a resurgence of corona again in China, and they have gone to a shutdown few provinces. So if that happens for a prolonged time, we might see a slowdown in China, and China being the consumer in many of the things. So it will affect across the world. So China's economy, all these things remains a concern. So we should be aware of the what is happening there. Now, this is one thing which we will never know, the unknown risk, and this is what affects the market. The kind of Evergrande blown up in some other part of the country, in some other major economy, something like that. Maybe you can never enumerate what is an unknown risk. But if an unknown risk, the only thing you can do is to have an asset allocation which addresses this unknown risk event or a black swan event. The primary market euphoria. This is sucking out a lot of secondary market liquidity. This is good. This is good. Many young entrepreneurs are they're getting money. Many unrepresented sectors are getting listed. So it's a good in a sense that we as an investor now have a choice to invest across sectors. But this had some side effect. The euphoria, the bad quality companies also come in. So properly do research on your IPO application and the companies you are going to invest. Consult your financial advisor, take views, and then only invest. Don't invest primarily because it is an IPO. No, don't do it. And this is how the dream run ends. So this is sucking out liquidity, and if it goes to that um, place where it starts really affecting the secondary market liquidity, then it is a cause of concern. But the biggest risk, what I feel, is selling too early by investors. Whatever said and done, we are in a structural bull market. Yes, we will see, and definitely there will be corrections. Maybe 15, 20, 25, you can never say, but there will be correction, and that's the nature of this market. It it has there has to be corrections for new people to get in. There has to be corrections in earning estimate. There has to be correction. But the problem with us is when we are sitting with profit, we think that let's sell this, and then the share price goes up by another two times. So what I feel, since we are structurally in a bull run, don't do this. Sit tight with your investments. Don't create this risk. So selling too early is the biggest risk, in at least for the near time being. Now I get a lot of phone calls and a lot of queries whenever I meet people that how to invest in crypto, what should I do, shall I invest? Then I say, if you are good with the fluctuation of crypto, which can in an hour, in a day fall 20, 40% in a day, why not then do an equity FNO? It gives you scope for research. It gives you similar kind of returns in an call, put, whatever, future, whatever be your instrument. So you could generate this kind of return through equity FNO. If you are interested and ready to take the fluctuation of crypto, try to start with an FNO. Why crypto? Because ultimately you need returns. So in a short span of time. And a call put will give you those kind of returns in a very short span of time. But if you still want to go about doing that, create a diversified basket. Don't buy only one of the cryptocurrencies like Bitcoin or Ethereum or whatever. Don't buy only a single coin. Buy different type of cryptos. Here also you should study the projects they are in, what problem it solves, the project, like Sandbox, like you have Algo, all these cryptos. So what problems is solved? So go through that. There will be a white papers listed somewhere in their website. Go through that. Who are the founders? What have they done? And how this is addressing some of the problems? How, why people will start this currency as an exchange medium? So do all this. Do your study, then create a diversified basket. What I do suggest to my clients, whoever has asked for the thing, I would do 80% of my uh, investment in crypto in large caps like Bitcoin and Ethereum, 10% in a mid cap like Cardano, and maybe another 10% in two of the small caps in crypto like Algo or maybe a Vibe, BAT, something like that. So, so have this kind of thing, but still have 80% of those things into large caps of crypto. And one other thing, I see a lot of ads being, a lot of exchanges being coming up. I would surely advise you to stick to the larger ones. Posirex, Binance, CoinDC, all these are there. So you can take your pick. And don't fall into the trap of FD. Some of them are offering FD on your crypto, because what they are doing is there is a huge difference between the bid and ask in their thing, in their exchanges. So you should at least clarify the rates from another exchange and see how much difference they are making. So they are actually doing a spread on your crypto when you are buying it and paying you a part of that as an FD or a fixed income. So verify the rates through two exchanges before buying a cryptocurrency. Now, portfolio construction. This is most important. If already invested, stay invested at least for the next 1.5 2 years. Stay invested. If market doesn't fall beyond 25%, don't do anything to your portfolio. Rather, what I would suggest to you is to support your existing portfolio by doing systematic investments. Or if you are not comfortable with a systematic investment, then have a rule that for certain percentage fall or certain points of fall of Nifty, you will keep on putting in money. Personally, whenever Nifty falls by 200 points, I buy. So that is how I have been investing. So you might have your own system, consult your financial advisor, so, and be alert. So something like that, or you might create your percentage terms thing that for every 2% fall, I will put in 1% of my corpus as fresh investment if you have money. Otherwise, stay invested. Funds are there to be invested. I would ask you to go for an STP for 3 to 6 months and construct the portfolio. And if possible, have an SIP also on these funds for the next 1 year, 1 to 2 years. So you support you ride the volatility, and but you need to be invested. You need to be there in this market. You should not miss this bull run. It's already at the middle of bull run, but it has a quite leg to go. On the fixed income side, it will be challenging. It is already challenging for the last 6 months. In a rising interest rate scenario, the fixed income bit takes a knock, but and the fixed income, fixed deposits, all these bonds will be available. The receipt takes time, so there is a lag of that also, of fresh issuances being issued at a higher YTM. So on the fixed income side, for the time being, stay with arbitrage funds, stay with floaters, and also an interesting thing, stay. You might look at some of the international rates, especially the advanced country rate, real estate investment trust or invest whatever you so infrastructure investment trust and those things, which gives you a alternative to fixed income part. You could also look at some quality market linked debentures, MLDs, which will give you a better return than your normal mutual funds and those things, mutual funds or debt instruments, whatever are available right now. So stick to shorter time horizon, very shorter time horizon, maybe a duration not more than a year, 1.2 years. That's the maximum you should have. And stick to arbitrage and floaters of these things, and have some part in this international REITs, which will also give you the dollar cushion. But you should only invest in really advanced or the matured economies, because the rental yields there are much more stable and much more than the emerging markets, because here the capital appreciation plays a major role in our uh, realization of total return, but there the rental yield are the major part of a real estate price. Asset allocation, always have a look on this. Every 6 months, you should do a review with your financial advisor. Stick to your asset allocation, do minor tweaking, have some tactical asset allocation, and overweight, underweight on certain asset classes. But more or less, don't go away, stray from your asset allocation. Have a thorough review with your financial advisor. And I hope this 2022, 2023, next 2, 3 years would be a major wealth creation years for you. Don't miss this. This is one of the time when the internal story of India is stronger than rest of the world. Actually, if you ask me, India might fall because of global reasons, but the internals of our own economy, at least the listed space, is quite sound. All the high frequency data that we are getting of GST collection and those things, maybe auto sales are also rebounding. So apart from the semiconductor uh, uh, shortages, we could have rebounded a stronger way. But all these things are showing that Indian economy is indeed roaring, and I want you all to ride this bus of wealth creation. A standard disclaimer, this is all my personal views and is for all educational purposes. Don't take this as any advice, and please consult your SEBI registered investment advisor before taking any investment decision. Thank you for your patience. Have a very happy new year. Signing off. Bye.